Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, President Trump cancels his summit with Kim Jong-un and may order new tariffs on foreign cars, inflaming trade tensions as a result. We will discuss the state of play with former U.S. Trade Representative Michael Froman. Plus, highlights from Viva Tech in Paris. As President Macron gathers the biggest names in technology, we will hear from the CEO of Consensus and the head of Uber's European operations. And Elon Musk is in hot water after another tweet tirade. Why is the Tesla CEO taking aim at the media? First, to our top story. President Trump canceled the June 12th summit with North Korea's Kim Jong-un, pointing to tremendous anger and open hostility from Pyongyang.
Based on the recent statement of North Korea, I have decided to terminate the planned summit in Singapore on June 12th. While many things can happen and a great opportunity lies ahead potentially, I believe that this is a tremendous setback for North Korea and indeed a setback for the world.
The decision is likely to have far-reaching geopolitical implications and comes just as trade negotiations with the U.S. and China are in a state of confusion. The U.S. is now investigating if auto imports are a risk to national security and may impose new tariffs on foreign cars. For more, we're joined by Michael Froman, former U.S. Trade Representative under President Obama, where he helped lead the conclusion of the Trans-Pacific Partnership Agreement. And before that, Ambassador Froman served as Obama's Deputy National Security Advisor for International Economic Affairs. He's currently Vice Chair and President of Strategic Growth at MasterCard. Michael, thank you so much for joining us. First of all, let's talk about North Korea more specifically. What do you expect to be the business fallout here and the fallout for the technology industry more specifically?
Well, the challenges that North Korea has posed to the international system have been enduring. They've been there for several administrations, and I think the Trump administration is coming to terms with the fact that this is a very difficult issue, a very complex issue to solve, and it's not a linear problem that can be easily dealt with. So it just adds to the uncertainty in the overall region. It creates dynamics between ourselves and South Korea and ourselves and China that could have spillover effects in the broader economic and geostrategic relationships. But it's going to be one of those complex problems. It's going to take a lot of hard work to get back on track.
Take a listen to what Secretary of State Mike Pompeo had to say about the talks with North Korea a couple of days ago and what's in it for Kim Jong-un.
He would find American investment, American technology, American know-how of real value to his people. And it's something that he and I had a chance to speak about generally.
Michael, how optimistic are you that we could see a reversal in decision here, or that this could at some point eventually happen?
Well, look, I'm no expert on North Korea. It's been a long-standing conflict. It's been very difficult to get forward movement on. Previous administrations have worked very hard to keep North Korea from becoming a global nuclear threat, and I think the Trump administration has got a lot on its hands if it's going to try and make progress there. You've got a very unpredictable leader on the other side, and a lot of interests that are difficult to reconcile, including vis-a-vis China, vis-a-vis the security of having a nuclear weapon, and the concern that giving it up might lead to regime change, and the challenges of regional security vis-a-vis South Korea, Japan, and China all at the same time.
China had supported this summit from the start. Could this give the U.S. and President Trump an opportunity to take an even harder line on China when it comes to trade?
Well, previous administrations have really tried to keep these issues separate. It was important to convey to China that we were going to defend our economic interests in their own right, regardless of what was happening on the national security side. It's in China's interests that there be stability on the Korean Peninsula, that there not be nuclear escalation. And therefore, in our view, traditionally, administrations have said we shouldn't have to pay China vis-a-vis trade for them to do what's in their own interest on national security. This administration has taken a slightly different view and has said, well, if China cooperates with us on North Korea, they'll get a better trade deal from us. And I think that everyone is trying to figure out exactly what that means. Does it mean fewer trade actions against China, or is there actually some negotiation that the administration thinks that they can do with China to put on the relationship on a better footing? But I think that this just shows how complex it is when you mix the two tracks of work of national security and economic issues. We ought to be focusing on the trade issues in and of themselves. We ought to be focusing on the national security issues in and of themselves.
Do you think that these frictions, if they continue to escalate, could undermine the technological progress of the United States itself and create a domino effect of trade protectionism?
I think to take that into maybe perhaps separate those two issues. I think there's a chance that there will be an escalation of protectionism. We've seen threats of tariffs go back and forth, and those put on hold while China and the U.S. continue their discussions from last week. Yesterday, we heard the announcement of the initiation of a so-called Section 232 investigation, which is a national security investigation into auto imports and the import of auto parts. All of that could lead to an escalation of protectionism. I think that's different than the role or the centrality of the U.S. in technological development. We have a great ecosystem for promoting technology development, and I think we will continue to make progress on that regardless of this risk of protectionism.
What do you think is your take on these potential car import tariffs?
The Section 232 law that this is being discussed under was really intended to be invoked when there was a threat to our national security. And when you go back, I think the last time it was invoked prior to this administration, it had to do with machine tools, where we were losing our capacity to build machine tools in the United States that were critical to building munitions. This administration has used 232 to try and prevent the import of steel and aluminum, arguing that our steel and aluminum industries were weak and that we needed a strong steel and aluminum industry if we were to remain a global power. That, I think, will be challenged by our trading partners, since we import most of our steel and aluminum from military allies of ours, like Canada or South Korea or Germany. When you bring it to cars, it's an even more difficult argument to make. It's hard to say we have a weak auto industry. We actually have a very strong auto industry, some of which is owned by U.S. companies and some of which is owned by foreign companies that build many of their cars here in the United States, both for the U.S. market and for export. I think the challenge here is we have always tried to limit the use of this provision in law because we were worried that other countries would use it to say anything as a national security issue. And if we open the door to that, if we open Pandora's box to countries invoking national security as a way of getting out of their trade obligations, my sense is we're going to find ourselves in a very difficult position with other countries closing their market to our exports because they think food is a national security issue or other manufactured products are a national security issue, and we won't be able to get our products into other markets. And that hurts jobs back here in the United States.
Take a listen to what the Australian trade minister had to say about the onset of a potential trade war.
Well, I certainly think we need to be vigilant and do all that we can to minimise or mitigate the risk of a trade war. I don't think that it's likely at this point in time. I think both the United States and China have indicated a certain amount of pragmatism. They're having discussions, and that's a big positive.
Michael, having been through this before, how likely do you think a full-blown trade war is?
I think the most likely outcome is that we avoid a trade war and that there is some sort of agreement. The question is what that agreement will look like. The administration has really sent two messages to China. One is that we care about the bilateral trade deficit and that they should buy more goods from the United States and fewer from other countries. And the other is that we want them to change their industrial policy so to prevent the forced transfer of technology to China or the theft of intellectual property from U.S. companies, those sorts of policies that put us and our companies at a disadvantage. Those are two very different issues. The first one is the one that they've been negotiating over with the Chinese delegation in Washington talking about what products they might buy in greater quantity. The second one is much harder to get at because China has doubled down on their Made in China 2025 objectives and have made clear that they want to become globally dominant in a number of key technological sectors. So it would require them backtracking from that in a way that might be difficult to negotiate. My sense is that the Chinese feel that if they can give President Trump a win on the bilateral trade deficit by promising to buy more soybeans from the U.S., more airplanes from the U.S., more tractors from the U.S., more LNG from the U.S., and less of all that from other countries, that will be enough to avoid a trade war, and that remains to be seen.
I do want to ask you about ZTE. The Chinese smartphone maker's fate hangs in the balance. The U.S. had implemented tough sanctions on them. Then President Trump talked about looking for alternatives. This was not received well in Congress. What line should the United States take on ZTE?
Well, I think it's very difficult to take a law enforcement issue, which is what the ZTE issue was initially. This is a country that was caught violating our export control laws, caught red-handed, and even with documentation that talked about how they were going to mislead the United States and other governments to avoid being caught. To now say we're willing to pull back on our punishment of ZTE on a law enforcement matter in order to make it part of a larger trade agreement, I think sets a very bad precedent. Sets a very strange message to our law enforcement officials that the laws that they are working to enforce could well be put over to the side for some other economic gain in the trade area. So I think we have to deal with the ZTE issue on its own feet. Whatever the appropriate punishment is, whether that's what was initially announced or some revised punishment, but not make it a chip to be traded away as part of a broader trade negotiation.
And yet, President Trump has several times now talked about his strong relationship with Chinese President Xi Jinping in the same breath that he is talking about ZTE. You know, what do you make of the signals that we are getting from the Chinese government? They've meantime cut import duties on a range of consumer goods. You know, what is that sending? What message is that sending to the United States?
I think China very much wants to reach a deal with the Trump administration, with the United States. I think they're being very pragmatic about it. As one official told me a year or so ago, they understand how important it is for President Trump to have tweetable deliverables, and they're perfectly prepared to give him tweetable deliverables, but they want to know what the price actually is. And so I think they're willing to come to the table and have a negotiation. And I think it's important to note that the Trump administration, in flagging these issues that China poses to the global trading system, these are real and legitimate issues. And the Trump administration has been successful in building really quite a broad consensus, not just in the United States, but around the world, that these are issues that merit attention. The question is how to deal with them and whether we can find a way of channeling China's efforts in a way that doesn't impose such a distortive effect on the global economy. Make sure, for example, that they fully implement their WTO obligations, obligations where even where they've been found to be in violation, that they actually take the remedial actions to put in place policies that bring them into compliance. Those are the sort of things that we ought to be doing with our allies, in collaboration with our allies, to put pressure on China to live by the rules of the open rules-based system.
Michael Froman, former trade ambassador for the United States. Michael, thank you so much.
Thanks for having me.
For that in-depth conversation.
Thank you.
A story we are watching. The cryptocurrency market is facing further regulator scrutiny. The Justice Department opened a criminal investigation into whether illegal practices like spoofing are flooding the market with fake orders to trick other traders into buying or selling are being used to trick traders into buying or selling, People Familiar said. Coins being examined include Bitcoin and Ether. Coming up, PIMCO-backed Green Sky hits the public market at a time when online lenders are not getting much love. We will hear from the CEO next. lenders haven't gotten much love from investors in recent years. Lending Club and competitor On Deck Capital have both dropped more than 70% since they went public in 2014. But PIMCO-backed GreenSky is banking on a different trajectory. Just went public on the NASDAQ, raising $874 million in its IPO. The online lender sold at $23 a share, driving its market value up to $4.35 billion. Bloomberg's IPO reporter Alex Barinka caught up with GreenSky CEO David Zellick.
GreenSky is a digital commerce platform. We power commerce at the point of sale for a growing ecosystem of merchants, consumers, and banks. We enable 12,000 businesses the ability to offer instant promotional credit and now serve almost 2 million consumers. There's a large and growing opportunity to accelerate commerce at the point of sale.
So when I do think of what the public market is used to in terms of past lending platform companies, Lending Club and On Deck, that trading in those two stocks effectively spooked the market for your industry. How did you differentiate yourself? How did you distance yourself from those two narratives, which have not been well received by the street?
We're about commerce, not credit. We enable over 12,000 businesses the ability to offer instant promotional credit to almost 2 million consumers.
And so you got your start mostly in the home loan business. For consumers who are looking to do home improvements, you're moving a bit into elective surgeries. Are those the areas that you're focusing on now? Where can investors expect you to push into next?
We have tremendous opportunities for growth. We have already had tremendous success in home improvement. We now have a rapidly growing elective medical business, a growing e-commerce business. Expect to see more verticals and more announcements to come.
David, your company's based in Atlanta. I grew up in Dallas. I know how folks love to improve their homes. Being outside of the Valley, being outside of New York, was that a strategic decision for you? Did that help you in terms of how you thought through development of your company and development of the product over at GreenSky?
You know, I'm grateful to Atlanta and Georgia. I moved there 22 years ago. What an incredible place to do business, to build a culture of service. I'm really pleased that when we started this company, it was all about creating value for our customers, our constituents, our people, and I'm really gratified that after all these years, that is being recognized. We really look forward to the years ahead.
And when I do take a look at your financials, you do have about $140 million in net income last year. Profitability is something that it continues to be a bit of a surprise for some startups, but you managed to get there. What was the thinking like? We see a lot of spending for growth at the expense of that bottom line. How did you manage your company in the past years that you've been operating to get to profitability pre-IPO, which again, seems to be a rarity these days?
Well, we think profit and cash flow never goes out of style. When we started this company 12 years ago, my partners and I bootstrapped it. We took every dollar we ever had. We borrowed money for years and years, so every dollar mattered. We weren't spending someone else's money. We were investing our own, and we were dedicated to creating value for our constituents and our customers. But when you have a technology platform, which is what we've built, and you create so much value for each member of our ecosystem, you can build a business, grow a business dramatically, and generate profit.
And that ecosystem being customers, the banks that are lending, and the merchants. As you think about your expansion in your existing markets and the home improvement lending and elective surgery markets and e-commerce, how much manpower, how much people capital in sales and marketing do you have to spend to get more of those three counterparties onto the platform?
You know, what's wonderful is now we're experiencing a tremendous network effect. You know, frankly, a majority of the businesses that join our network are referred to their colleagues and friends and sometimes competitors. So we're certainly very gratified by that. We spend less than 5% of revenue on sales and marketing. And that's what happens when you have an ecosystem, a network, and a value proposition that really creates value for businesses, consumers, and our bank partners.
And David, you know, the chatter continues about the potential turn in the credit cycle. How do you think through where we are in the cycle right now? Are there things you're doing to prepare Green Sky to keep running your business if we do see a negative turn in the credit cycle?
Right. So Green Sky is not a lender. We're not a balance sheet. We're a technology platform. And we know that not if, but when a recession happens, commerce will continue, purchases will continue, and in fact, credit will become even more important to consumers. Our bank partners are committed to growing through the cycles a quality, profitable, durable business.
That was our Bloomberg IPO reporter, Alex Barinko, with Green Sky CEO David Zellick. Coming up, the world's second largest PC maker posts the biggest jump in sales in almost 2 years. We're going to hear from Lenovo's CFO next. This is Bloomberg. In the latest quarter, Lenovo posted its first double-digit percentage increase in sales since late 2015. This is a bit of a recovery for the company since it became the world's worst-performing tech stocks as its smartphones struggle for relevance and it loses ground to rivals like HP. Bloomberg's Stephen Engel caught up with Lenovo CFO Wang Ming and asked about its presence in the smartphone market.
We are aware that we didn't do as well as what we expect, but nevertheless, I think we saw that very solid actions taken, I think, back in Q4, March this year. I think really we look at the business, I think generally, I think the numbers actually show a decline, but if you really look at the core markets, Latin America, we see increase in both top line as well as profitability. North America, we see significant growth in unit.
And Twitter has rolled out stricter rules for political advertising in a bid to increase transparency and curb manipulation on the service. This ahead of the U.S. midterm elections in November. The company will require advertisers running political ad campaigns for federal elections to both identify themselves and certify they are located in the United States. And coming up, avoiding the valley, where to look for stable tech investments outside of the obvious. That is next. And later, Viva Tech underway in Paris. We're going to hear from Uber's head of Europe about the company's operations there. And we will, as we head to break, take a listen to Uber CEO Dara Khosrowshahi discussing the company's plans for driving tests after a fatal accident in Arizona last March.
I think for us, it really brought home this idea that safety has to come first. And as it relates to that tragedy, we have grounded our autonomous fleet, and that was a decision that we made.
Any sense for when you'll start driving again?
It'll be within the next few months.
This is Bloomberg Technology. I'm Emily Chang in San Francisco. It has been a volatile year so far for big tech. Just look at the performance of the typical tech stalwarts like Facebook, Amazon, and Alphabet so far this year. My next guest says that Silicon Valley is not as attractive an opportunity given the volume and overvaluation of investments already. Instead, he is looking at long-term investments that can weather that kind of volatility. He's the head of KKR's TMT Growth Equity, whose portfolio includes companies like Lyft, Magic Leap, FanDuel, and more. David Welsh here with me in the studio. Thanks so much for joining us.
Thanks, Emily, for having me.
So why not Silicon Valley?
Well, I think it's a little less about why not Silicon Valley. There's certainly tons of great tech companies being formed here, and there, I think, will be for a long time. I think it's, as we've looked at it, there's just a lot of companies in other areas in both the U.S. and abroad that are starting to produce really great technology companies too. And to your point, some of the valuations here, particularly in Silicon Valley, have really gone up a lot recently. So we've been spending a lot of time on planes, getting to know those other geographies and the businesses that are there, and learning that there's some really great entrepreneurs and people that are looking to build, as you said, long-term businesses that can sustain through multiple cycles. And that's some of the things that we really look for in businesses. So we're really...
Specifically, do you see potential?
Yeah, so we've been spending time in areas like Denver, in areas like Salt Lake City, Seattle, even down in LA, out in the East Coast in Florida, and other places, Austin, Texas. Some of the places that have had some traditional good depth in the environment there that are now really starting to build up these bigger businesses.
So what kind of trends are you investing in? I mean, you're not doing early stage, you're not doing pre-IPO
Right.
companies. What are you looking for?
Yeah, so we're really looking for, I think, 3 key attributes. One thing is we want businesses that we've actually seen for a while, and we've seen them execute through multiple, sort of cycles up and down, and have had an opportunity to watch them really show real good product market fit in what they do. I think importantly, what we're also looking for is businesses where the management team and existing investors want to build something, large and aren't trying to do a quick flip. So it's markets and technologies that we think can sustain for a long time. With that ambition, though, we want people that are disciplined. So we want them to be able to look at a business model and say, this is a business model that not only will work while things are going well economically, but can also, weather that, that storm if there is an economic downturn. So it's more characteristics of those types that we're looking for, and then we apply those across multiple industries and multiple technology types when we're looking for things.
So you've been doing this for about 1.5 years so
Right.
far. Any specific learnings, or it's not an incredibly long time?
Yeah.
Successes, challenges.
Sure. So I think that the learning has been that the way that we're looking at things seems to be resonating with other investors and the entrepreneurs. That is that when we find the right teams that want to partner for the long haul and can describe to them that the things that KKR can bring as a platform, they really then realize that we can help them both accelerate potentially and solidify their ability to get to be a big market leader. So the learning for us has been find the right teams and the right businesses that really are looking to build for the long haul and really focus our energy there, as opposed to doing what some investors that have come in the later stages have done, which is try to time the market or try to do something that might be a quick return. That's never been KKR's way, and that's not the way we want to operate our fund. So we're really trying to partner with businesses that are trying to build for a sustainable long outcome.
So you invested in Lyft, for example, in 2016. This
Right.
is before Uber
Yeah.
exploded.
Yeah.
But now Uber is coming back, new leadership.
Yeah.
We know that Lyft did gain market share as a result of that, but are they losing some market share now that Uber is back on its feet?
No, we haven't seen that. I mean, I won't get into specific numbers, mostly because I don't have all of them, but I will say they continue to grow well. We think they're doing fine from a market share gain. The point on Lyft for us was when we invested, they were already a fairly large business, but what we saw in them was a management team that was very dedicated to continuing to grow a lot and wasn't looking for a quick exit, and that's really played out. I mean, we've had some fortunate tailwinds behind us in different ways with the business, but I'd say the thesis of them coming and working with us and other investors to continue to build the business for the long haul, that was the big thesis, and that's been working really, really well for them.
What about a company like Magic Leap, which has raised a ton of money but has no products on the market yet, and it's been a few years?
Yeah. So that's a little bit of an anomaly investment for us. That was done very early when we started getting into growth 3 or 4 years ago. It actually did predate me. I think that's occasionally we will do something where we think there's a really huge market and a completely transformative technology where we might come in and take a little bit more of a passive role, but that was really more of a historical investment. Most of the things that we're doing going forward, we'd be less likely to do that and would look for things that have better already product market fit.
Okay, but if it is so great, then why haven't we seen anything from them?
Well, again, not close enough to the inside of Magic Leap to give you real specifics. What I do know is they continue to make real good progress on the technology and on the products. I think they've rightfully wanted to wait to make sure they produce or sort of expose things when they're really ready to go and feel like it's something that's going to be consumer ready.
You're also an investor in FanDuel, which just had a huge victory with the Supreme Court ruling that the ban on sports betting is unconstitutional. They're now being acquired by a UK betting company called Paddy Power, which, as we understand, values the company at $1 billion plus. Is that a good exit for you?
Well, so actually, that combination is not about the exit. That combination is about forming something we think will be really long haul, sort of benefit from the tailwinds of PASB, the betting rule being overturned by the Supreme Court, as well as the daily fantasy market continuing to grow. So we actually aren't exiting the business with this merger. We're actually joining together, holding the stock of the combined entity and looking to grow it over time, and then we'll have an exit when the markets have really valued that business where we think it can go given the tailwinds.
So talking about volatility, does this mean you'd be allergic to crypto?
Well, I don't know if allergic to crypto. Probably a little skeptical of it being a long-term investment that would be right for us. And that's mostly because when we look at things, we really are looking at fundamentals, and we're looking at where is the business based today on its fundamentals. How do you value that based on the fundamentals of today? And with all of the up and downs and sort of the untying sometimes of crypto to fundamentals, it's tougher for us to get our head around that as being sort of a core asset that we'd want to invest around.
How is the competitive landscape changing for you? Obviously, there's the sort of typical hedge funds and mutual funds, and also SoftBank has $100 billion to invest, and they're also looking outside Silicon Valley.
Yeah, so we've really broken the landscape. For us, it's really broken into three parts. There's the early stage venture guys that have started to go later stage. There's the crossover funds, the mutual funds, and the hedge funds. And then there are sort of more traditional growth players. The early stage guys, we don't see much. They tend to still take a lot of product market risk and come in earlier than us. The crossover guys kind of do what I was talking about before. They tend to come in trying to time an exit maybe a year or two, beforehand, and don't really take an active role in the business. And so we don't actually see them very often. We do see there's a core set of growth investors that are actually trying to invest in these bit larger businesses, but that still have a lot of runway. That actual core set is not as big as people think. I mean, and especially those that want to provide real value-added services in the way that we do with our businesses, it starts to become pretty limited. So there is competitive sets, and they're definitely, sort of all of them are going more geographically dispersed. But we're actually finding that we're competing pretty well in that core set of firms that we really see as our competition.
So you talked about staying away from particularly high valuations. Do you think the tech industry is reaching a plateau? I mean, is it a bit bubbly?
Yeah.
Is it going to pop?
Yeah. Well, I certainly feel like valuations are probably somewhere on the higher end than the lower end of where they're going to be, in a cycle. Whether we're at the top or whether it's the top of a bubble, it's probably not, I'm not the best person to guess on that. What we do know is we stay really true to the fundamental metrics of valuing businesses. We look at things like the right ratios relative to where businesses have been over the long haul. And in some of the cases here in the Silicon Valley in particular, those have gotten a bit out of whack. And so that's driven us to, kind of go to other geographies or to be very disciplined in the businesses that we've looked at and really try to develop a relationship with a company that says, yes, you might be able to get just a slightly higher valuation from somebody, but does that really matter? What matters is the value you can build over time. And so we often will work with businesses that say, we're not going to take the absolute highest valuation we can. Rather, we're going to come in with the right investor that can build and give us the best outcome over time.
All right, Dave Welsh, head of TMT Growth Equity, KKR.
Thank you
so much.
Thank you.
All right, a disturbing story about Amazon's Alexa is sparking privacy concerns related to voice-activated devices. A couple's private conversation was mysteriously recorded by their Amazon Echo device and then sent to one of their contacts. This according to a report from Kiro 7. The couple found out only when they received a phone call 2 weeks ago from one of the husband's employees telling them to unplug your Alexa right now, you're being hacked. Amazon told the station it was a, quote, extremely rare occurrence. Coming up, we head to Viva Tech in Paris to hear about what the founder of Ethereum thinks of cryptocurrency regulation. But before that, take a listen to French President Macron telling the crowd how he wants to level the playing field for startups competing with tech giants.
A lot of the startups are competing with large corporates, and they tell me, I pay tax in France. We are decreasing these taxes, fine. But it's not fair where somebody else pays no tax. That's why I'm a strong supporter, and I will fight till the end for this European digital tax for big players. I think it's fair, it's good for everybody, and it's sustainable.
After years of losses, Uber has turned a profit in the first quarter of the year. Sort of. Uber posted a $2.5 billion profit after accounting for the value of selling its Southeast Asia business to Grab and its Russia business to Yandex. But without those windfalls, it would be a different story. Uber had a loss of $312 million before interest, taxes, and other expenses in the quarter, half of what it incurred the year before. Speaking of Uber's financial status, Uber CEO Dara Khosrowshahi took to the stage at the Viva Tech conference in Paris to tell people that Uber will be profitable one day, but he just can't tell them when. Khosrowshahi also announced two new initiatives, one involving a Paris-based flying car research lab and the other centered around the safety of Uber's drivers and passengers. Our Caroline Hyde caught up with Pierre-Dimitri Corgotti, the head of Uber in Europe, Middle East, and Africa, to find out more.
That was the opportunity for us to make actually two big announcements. One announcement that has to do with a partnership with the insurance provider AXA that aims at bringing some sort of a social safety net to all the drivers and couriers that are using Uber across Europe. The second announcement we've made is actually an investment of 20 million euros in France, here in Paris, in partnership with Polytechnique, which is one of the leading engineering schools, that aims actually at developing a research center in the field of urban mobility, and especially how we take urban mobility from 2 dimensions today to 3 dimensions with flying drones and flying taxis, as we call them.
Before we get into the excitement of flying cars, let's stick to the driver part of the business at the moment, because do you think this is enough to assuage the issues about the gig economy? Do you think this will be able to show that flexibility can be teamed with protection for the workers?
My sense is there's probably more to do, frankly, and it's not just about Uber, it's about the industry, but this is actually something that I am very proud of at the moment. My sense is we haven't done a good enough job when it comes to listening to drivers. We've had a bit of an approach which was growth at all costs, and we're trying to pivot as a company to more responsible growth. And that starts by listening to drivers. And one of the things they told us is, yes, we value the flexibility that you bring to our lives, but at the same time, we want to have the sort of social safety net that exists in the traditional employment work. And so with the growth of independent employment, we feel that it's actually very important to figure out how we can create that sort of safety net, and that's about us partnering with governments and about the whole sector, so that drivers still feel protected and have that peace of mind that they are after.
What about protection of the user as well, the passenger? Because that is something that perhaps the UK called into question with the London TfL, worried about safety standards. You're all looking to appeal that particular decision on your license. Are you confident about it?
So the first thing is safety, and safety of the users is our #1 priority as a company. And this is one of the moves that Dara, our new CEO, made when he joined the company a few months back. When it comes to the situation in London, I think the refusal of the license that we got a few months back is a good reflection for us of some of the mistakes we made in the past, and that was a great catalyst for us to just take a deep look at ourselves and think about how we can just be a better partner, a better, rebuild the trust that we eroded over time. And with that in mind, we made a number of significant changes to how we do business, putting integrity at the core of everything we do. And I'm hopeful that with those changes, we'll actually be able to get our license back. But this is up for the court to decide, and there's obviously a court hearing in June, so very soon.
Uber's head of EMEA there, Pierre-Dimitri Corgotti. And while still at Viva Tech, Caroline spoke with Joe Lubin, CEO of Consensus Systems and the founder of the Ethereum cryptocurrency platform, to get his thoughts on the news that the U.S. Department of Justice has opened a criminal probe into possible manipulation of the price of Bitcoin and other cryptocurrencies.
As a software company, Consensus just focuses on building the infrastructure and software applications on the decentralized web, basically Ethereum and other protocols. So we don't focus too much on cryptocurrencies. That said, it is really valuable to have regulators in the space taking a look at some of the complicated practices in much less regulated situations. So whether it's with respect to cryptocurrency, and cryptocurrencies, in my opinion, should remain unfettered because there are tremendous use cases, or whether it's tokens representing equities or other kinds of assets, and how that maps into securities law. We're very happy to see the work that regulators in the United States and in different parts of the world are doing.
Do you think they likely have been open to manipulation?
So I am not deeply aware of the activities in the cryptocurrency trading space. We just don't do that sort of thing. There certainly are price swings. It could be just because the total value of these monetary bases are small, and it's a very young technology and lots of news is coming out. But traders are sophisticated. Traders will do what they can get away with.
Let's talk about the conversations you're having with the regulators at the moment. How are you going around? What are the questions you're being asked? What are the key issues that you think you currently face and the challenges to overcome?
Yeah, so we're mostly focused on securities law. We are able to issue investor tokens or tokenized securities. We're also able to issue consumer utility tokens that wouldn't be considered securities, and we're focused on getting very clear definitions and helping regulators around the world understand that there are these networked business models that benefit from membership tokens or tokens that represent consumption of scarce resources. And as long as these projects are selling tokens to token buyers that make use of the token, and they're not selling in large quantities to speculators who are hoping to make money by the actions of others, that is a good, clean definition of a consumer token.
And that's what Ether is.
That is absolutely what Ether is. We did about 7 months of deep legal homework. Ether is a crypto fuel. It's one of the first crypto commodities in the decentralized World Wide Web, Web3. Others are for decentralized storage and bandwidth and heavy compute. On Ethereum, you can do trusted transactions, automated agreements, smart software objects. In order to pay for all the shared resources, you need to pay with some of this crypto fuel. And so that token represents essentially a way of offering these shared resources to the world.
That was Consensus Systems founder Joe Lubin speaking to Bloomberg's Caroline Hyde at the Viva Tech conference in Paris. Coming up, Elon Musk on another Twitter tirade, taking cracks at the media, and more we will discuss next. This is Bloomberg. Just weeks after Elon Musk's bizarre behavior on an earnings call, he is back at it on Twitter. The Tesla CEO is out with a series of combative tweets this week, attacking the media over critical news reporting and more. Here to dissect that, as well as what else Musk is talking about, we've got Bloomberg Business Week's Max Chafkin, who covers Tesla and all things Elon Musk. So I want to start with a couple of these tweets, Max. The holier-than-thou hypocrisy of big media companies who lay claim to the truth but publish only enough to sugarcoat the lie is why the public no longer respects them. Going to create a site where the public can rate the core truth of any article and track the credibility score over time of each journalist, editor, and publication. Thinking of calling it Pravda. Your take?
I have not checked my Pravda score yet, but I think the bottom line here is that, this is part of a long, running pattern with Elon Musk that goes back pretty much since the beginning of Tesla. He's often complained that basically the media was in the pocket of the oil industry and Detroit. I think what's happening here is you have a series of sort of news stories, none of which are super bad for Tesla, but maybe when they start adding up, piled on the fact that Tesla is in this sort of mode that Musk has described as production hell, that is creating pressure and perhaps leading to this kind of this Twitter rant.
Some of the things he's not so happy about: the media scrutinizing cash burn in your GTV library. You can see a chart there that shows Tesla's cash burn, which is quite extreme. Also, cars produced also not looking great. Max, talk to us a little bit about the big problems that Elon Musk really does have to worry about.
Yeah, so probably I'd say the most significant thing that happened over the past couple of days was Consumer Reports, which is widely respected as a kind of, arbiter of quality in cars, came out with a report criticizing Tesla's, the braking of the Model 3. There's kind of a small issue. Tesla says they're going to fix it. That's one thing. There's been this continued back and forth with various labor groups over conditions at the factory. In fact, there's an NLRB complaint filed over an unrelated tweet. And as you say, on top of that, they're just trying to get as many cars out the door as they possibly can. And again, that's it's this kind of soup of stuff that creates pressure on the company.
He also seems to have picked a random date, March 15th, to unveil Tesla's Model Y, and then he has stuck with it. What do you make of that?
So the Model Y is the SUV version of the Model 3. So the Model 3 is their sort of smaller, sort of lower end luxury car. So the Model Y, you would imagine, is going to be kind of like a compact SUV, which is very popular class of car. It's something that Tesla really needs to have in the long run. The March 15th date, he said that it just sort of sounded good and has seemed to stick with it. Tesla has since put out some statements, or Elon has since put out some statements indicating, it could shift a little bit, but that it's a pretty good guess. What they have said is that production would start at the beginning of 2020. So you got to think, that's sort of around the time when they'd want to launch it and start taking pre-orders. And so I wouldn't make too much of it. I mean, the one thing to say here is that one thing that's allowed Tesla to maintain this, very high valuation relative to its revenue and lack of profit is the fact that there is this continuous stream of kind of exciting new announcements that Musk and his team have been able to kind of put out there. And so Model Y becomes very important there, because if they're able to create a lot of excitement around this SUV, that maybe gives them a little bit more runway, allows them to continue to basically borrow money for nothing, and allows them to get whatever production problems they need to get them fixed in time, and then hopefully down the road start making money.
All right, Max Chafkin, Bloomberg Business Week. We'll see what Musk does tomorrow. And that does it for this edition of Bloomberg Technology. Tomorrow, we're going to talk about everything you need to know about GDPR, the sweeping personal data regulations going into effect in Europe. That is all for now. This is Bloomberg.